You walk into your local bank branch. You see the polished marble floors. You see the heavy steel vault door in the back. And most importantly, you see that little gold and black sticker on the glass door. Member FDIC. Insured. Safe. You have been trained since birth to believe that sticker is a magic shield. You deposit your life savings, your retirement, the money for your children's future, and you sleep soundly because the government has guaranteed that up to $250,000 of that money is untouchable. You are living inside a mathematical impossibility. That sticker is not a shield. It is a blindfold. The reality of the modern banking system is not built on vaults and gold bars. It is built on confidence, debt, and a ledger that is currently flashing red. We are going to look at the raw numbers today, not the headlines, not the press releases from the Federal Reserve, but the cold, hard arithmetic that they are terrified you will understand. The Deposit Insurance Corporation, the entity standing between you and total destitution during a banking collapse, does not have the money. They don't have half of it. They don't have 10% of it. As of the latest reporting, the Deposit Insurance Fund ratio is hovering around 1.2%. Let that sink in. 1.2%. For every $100 you see on your banking app, the insurance company has $1.20 to cover it. If a single massive bank fails, they can print the difference. If two fail, they might manage. But we are staring down the barrel of 2026, a year where commercial real estate loans mature and interest rates crush the balance sheets of regional banks across America and Europe. If the dominoes start falling, that 1.2% will vaporize in seconds. The math implies that 98.8% of the protection you think you have is an illusion. And when the illusion breaks, the money doesn't just get delayed, it gets erased. Before we pull back the curtain on this mechanism, I want you to go down to the comments right now. Tell me what country or state you are watching from. And tell me, do you trust your bank to give you your cash if the system goes dark tomorrow? Because what I am about to show you suggests that trust is the most dangerous asset you own.
To understand the scale of the lie, we have to look at the architecture of the trap. This isn't the first time the public has been lulled into a false sense of security right before the floor dropped out. We saw it in 1929. We saw it in 2008. But the setup for 2026 is mathematically worse. In the 1930s, when the banks collapsed, people stood in lines for days, banging on the doors, only to be told there was nothing left. The money was gone because the banks had lent it out to people who couldn't pay it back. The government's solution was to create the FDIC in 1933. The pitch was simple. Put your money back in the banks, and we promise to pay you if the bank fails. It worked. Confidence returned. But notice the word confidence. The system wasn't fixed. The psychology was patched. Fast forward to 2008. The housing market collapses. Banks are leveraged 30-1. They are insolvent. By all laws of capitalism, they should have been liquidated. But they weren't. The government stepped in, not with insurance money, because the insurance fund was empty even then, but with the printing press. They diluted the value of your currency to save the institutions that gambled with your savings. Sound familiar? It should. Because in March of 2023, we saw a glimpse of the future. Silicon Valley Bank, a massive institution, collapsed in 48 hours. The speed of the run was unprecedented. Digital banking allowed billions to flee in seconds. The FDIC fund took a massive hit. To stop the panic from spreading to every regional bank in America, the government had to break their own rules. They invoked a systemic risk exception to cover deposits over the $250,000 limit. Why? Because they knew that if they let even one wealthy depositor lose money, the faith in the entire 1.2% reserve ratio would shatter. They panicked. They printed. They kicked the can. But here is where the parallel gets terrifying. In 2008, the toxic asset was residential mortgages. Everyone owned a home they couldn't afford. Today, the toxic asset is commercial real estate and government bonds. Banks are sitting on hundreds of billions of dollars in unrealized losses. These are losses that technically don't exist until they have to sell the asset. It's like saying you haven't lost money on a car you crashed until you try to sell it to the junkyard. The car is totaled. The bank is totaled. They are just hoping you don't ask for the keys. Sound familiar? It is the same script, different actors. But this time, the scale of the leverage is hidden in the derivatives market, a shadow banking system worth quadrillions of dollars. The FDIC acts like a homeowner with a fire extinguisher, claiming they can put out a forest fire. It is a beautiful sentiment, but functionally useless against the inferno that is coming. We are told that the banking system is sound and resilient. We heard those exact words from the Treasury Secretary days before Silicon Valley Bank imploded. We heard those exact words in 2007. We heard them in 1929. Whenever a government official feels the need to tell you your money is safe, it is usually the strongest signal that it is not. Sound familiar? The mechanism of the theft is subtle. It isn't a man in a mask taking your wallet. It is a legislative pen stroke that changes the definition of ownership. Most people believe that when they deposit money into a bank, it is like putting a coat in a cloakroom. You give them the coat, they give you a ticket, and later you hand back the ticket to get your coat. That is custody. That is not banking. When you deposit money legally, you are lending money to the bank. You are an unsecured creditor. The money is no longer yours. It belongs to the corporation. You hold an IOU. And if that corporation goes bankrupt, you stand in line behind the bondholders, the secured creditors, and the derivatives counterparties. And this brings us to the mechanism that they carefully avoid discussing on the evening news.
The bail-in. After 2008, the world governments realized they couldn't bail out banks with taxpayer money again without causing a revolution. So they passed new laws. In the U.S., it was the Dodd-Frank Act. In Europe, the Bank Recovery and Resolution Directive. These laws legally allow a failing bank to take your deposits and convert them into bank equity. They don't pay you back. They give you worthless stock in the failing bank. They call it a bail-in to save the system. You wake up on a Tuesday thinking you have $50,000 in savings, and by Wednesday, you have 50,000 shares of a bankrupt bank and zero cash. This happened in Cyprus. It is legal. It is on the books.
And the FDIC Insurance Fund is the smokescreen that keeps you from reading the fine print. But the receipt is wilder than you think. Let's look at the core mathematics of this fraud. We need to strip away the jargon and look at the ledger. As of the most recent quarterly data, the total amount of deposits in United States commercial banks is roughly $17 trillion. That is a 17 with 12 zeros behind it. Now let's look at the Deposit Insurance Fund, the DIF. This is the piggy bank that the FDIC holds to pay you back if the banks fail. That fund holds approximately $128 billion. Do the division. 128 billion divided by 17 trillion. That is 0.7% coverage of total deposits. Even if we look at only the insured deposits, the ones under the limit, the ratio is roughly 1.25%. This is not insurance. This is a fractional reserve applied to the insurance itself. It operates on the assumption that only one or two small banks will fail at a time. It is designed for a fender bender, not a 20-car pileup. But the banking system is highly interconnected. Banks lend to each other. They hold the same assets. If interest rates stay high, which they must to fight inflation, the value of the bonds these banks hold continues to drop. Currently, U.S. banks are sitting on over $600 billion in unrealized losses on investment securities. That number alone, $600 billion, is nearly 5 times larger than the entire FDIC Insurance Fund.
If the banks were forced to sell those assets today to pay out depositors, the entire insurance fund would be wiped out 5 times over, just covering the gap. And that doesn't even touch the deposits themselves. So what happens if a major crisis hits in 2026? Let's assume a medium-sized banking crisis, not a total apocalypse, just a severe recession. Let's say 10% of banks become insolvent. That would require a payout of $1.7 trillion. The FDIC has $128 billion. Where does the other $1.5 trillion come from? The FDIC has a credit line with the U.S. Treasury. Basically, they can borrow money from the government. But the government has $34 trillion in debt and runs a deficit every year. The government doesn't have the money either. So the Treasury has to issue bonds. Who buys the bonds? If the world is in a recession, nobody. So the Federal Reserve steps in. They create new digital dollars to buy the bonds, to give to the Treasury, to lend to the FDIC, to give to you. This is the cycle of destruction. To save your deposits, they must dilute the currency. If you have $100,000 in the bank and the system fails, they will make sure you get your $100,000 back. They will print it. They will fly it to you in a helicopter if they have to. But by the time that money reaches your hands, the cost of a loaf of bread will be $50. They are preserving the nominal value of your account
while destroying the purchasing power of your life. It is a theft that happens without a single law being broken. Now, let's layer in the 2026 trigger: commercial real estate. In the next 24 months, a massive wall of commercial real estate debt is maturing. Trillions of dollars in loans for office buildings, malls, and commercial centers need to be refinanced. But these loans were originated when interest rates were near zero. Now rates are 5% or higher. And the buildings? They are empty. Remote work has decimated the value of office towers in San Francisco, New York, and Chicago. Who holds these bad loans? Small and mid-size regional banks. These are the same banks that hold your deposits. When the developers default on these loans, and they will, because the math of refinancing at these rates is impossible, the banks will be left holding assets that are worth half of what they loaned out. Their capital buffers will vanish. They will become insolvent.
This isn't a theory. It is a mathematical certainty based on loan maturity dates. The clock is ticking toward 2026. And when these banks go under, the FDIC will step up to the podium, they will show you the sticker, they will speak calmly, and they will look at their account balance of $120 billion against a wave of trillion-dollar defaults. At that moment, the lie ends. They will have two choices. Choice A: let the system collapse. Bail in the depositors, take your money to save the bank, and cause a deflationary depression that rivals the 1930s. Choice B: hyperinflate the currency to bail everyone out, turning the US dollar into confetti. History shows they always choose inflation. They always choose the printing press, because it is easier to rob you slowly through inflation than to rob you quickly through a default. The mechanism of repo markets plays a crucial role here too. Banks use these government bonds as collateral to get overnight cash to function. When the value of that collateral falls, they get a margin call. If they can't pay, they shut down. In March 2020, the repo market froze. The Fed printed trillions to unfreeze it. In 2023, the banks froze. The Fed printed hundreds of billions. Every time they intervene, the numbers get bigger. The balloon gets tighter, and the needle of 2026 is getting sharper. You are living in a period of extend and pretend. The regulators are allowing banks to pretend these bad loans are still good. They are extending the deadlines, hoping for a miracle, hoping that interest rates will drop back to zero, hoping that you will keep your money in the system. But hope is not a strategy, and a 1.2% reserve ratio is not insurance. It is a gamble, and they are gambling with your chips. Look at the hierarchy of risk. At the top, you have the owners of the bank. They take the profit. Below them, the bondholders. Below them, you, the depositor. If you look at the fine print of your bank agreement, you will see clauses regarding holding periods, withdrawal limits, and force majeure. They have built the gates to keep your money in when the fire starts. Digital central bank currencies, or CBDCs, are the final piece of this puzzle. If the banking system collapses in 2026, the solution offered will likely be a direct account with the Fed, a digital dollar.
To get your FDIC payout, you may be required to sign up for a programmable currency that dictates where and how you can spend. It is the perfect trap. The crisis creates the demand for the solution that enslaves you. The FDIC lie is the keystone that holds this entire psychological structure together. Without the belief that the government can save everyone, the run on the banks would start tomorrow. And because of fractional reserve banking, if everyone asks for their money at once, the system ceases to exist. We are entering the most dangerous financial window of our lifetimes. The convergence of debt maturity, high interest rates, and geopolitical instability creates a perfect storm for a banking crisis that the FDIC cannot handle. The silence from the mainstream media regarding the commercial real estate cliff is deafening. They are talking about the stock market highs. They are talking about political scandals. They are distracting you while the foundation of the vault rots away. So, what is the action plan? This is not financial advice, but it is common sense survival. You cannot rely on a 1.2% buffer. You must become your own central bank. Diversification is no longer a luxury, it is a necessity. If your entire net worth is sitting in digits in a single bank account, you are effectively betting your life that the politicians can defy the laws of mathematics.
You need assets that have no counterparty risk. Assets that do not require a bank to exist. Gold, silver, land, Bitcoin held in self-custody. Things that cannot be bailed in, printed away, or frozen by a banking algorithm. The danger of denial is the greatest risk you face. It is comfortable to believe the sticker on the door. It is comfortable to believe that 2008 was a one-time event and that the adults in the room have fixed the problems. But the numbers don't lie. The leverage is higher, the debt is higher, and the insurance fund is a drop of water in an ocean of liability. The year 2026 is approaching. The maturity wall is real. The question is not if the banks will face a crisis, but whether you will be standing inside the bank when the doors lock, holding a receipt for money that no longer exists. The math doesn't add up. And when the equation finally resolves, make sure you're not the variable that gets subtracted. Subscribe to this channel if you want the unfiltered truth about the economy, the money, and the future they are trying to hide from you. We will see you in the next one.